Welcome to Hi everybody. Welcome to IRMAN Talks. We today have Puneet from PRM 20. He is the founder of Kaleidofin, which is primarily working with AI and data innovation in financial inclusion. Prior to Kaleidofin, he had been associated with Dwara Trust and also with Northern Arc Capital. He currently serves on the investment committee at the incubation cell at IIT Madras also. He has been somebody who's been harnessing the power of technology to amplify the role of financial services across the lives of millions of customers. At Kaleidofin, they've partnered with about 65 institutions, touched about 35 million lives. And I think um, this exact expertise and how exactly did Kaleidofin really come up to where it is and how did this journey really span out has been pretty interesting, and that's what we would welcome Puneet for in this talk. Hi Puneet. So without further ado, it'd be great if you can give a small introduction of yours and wi- and a small introduction how your career, which is in the intersection of finance, technology, and inclusion, how has it really spanned about?
Yeah, Mani, thank you so much for having me here today. It's always special to come back to speak to members of the alumni. Thank you for giving me the opportunity. Um, so, I think the journey at Kaleidofin, or actually my entire journey after IRMA has been a very interesting one. I must confess, I didn't start with finance at all. Um, After IRMA, I was very focused on education. And as far as I was concerned, I actually took a plunge to see what can be done to improve the quality of education in rural schools, especially government schools. So that was really where I started off with. But life has a way of nudging you towards a certain direction. I think very soon my boss and I both realized that education was not something that I should be focusing on. I think my batchmates already knew that I should have picked up finance. It took me a little bit of time to really get into the financial space. Uh, but I think the moment I switched to financial services, I think I realized that I had found my calling. Um, the moment I'd gone to all our field inductions and then to the village field work, one thing was very clear in my mind that the economic opportunities available to people need to improve. And one thing that became very clear was that in developing countries such as India, a very large proportion of population works in the informal sector. Um, and this informal sector has one key characteristic, which is that most people are self-employed. And in order to set up their enterprise, they need some kind of access to capital. So if you don't have those two cows at home, there is no ability for you to generate any milk, and which is what Amul revolutionized. Or if you don't have that motorbike, you can't get a job in the gig economy. Or if you don't have that small shop, there is no way you can earn any livelihood whatsoever. Wage labor is not always an option. And given this important aspect, access to credit becomes critical. If you are able to access credit, you're able to make investments in your enterprises. And that typically is the one thing that starts to move you away from poverty, moves you towards better incomes, and over a period of time, a better quality of life. And that just became a mission. So that's what I've then followed through the rest of my 25 years of having passed out of it.
Interesting. So I think, one bit of it was, of course, the opportunity that you saw. But then when we talk about Kaleidofin, we're also looking at AI and data and how you're leveraging it. So it'd be interesting to know as to how really did you see, what exactly was the gap in the financial ecosystem that led you to, bring about Kaleidofin, and how exactly is Kaleidofin leveraging AI and data differently from the traditional credit models?
Yeah. So let's first begin with just the gap in the financial ecosystem that even got Kaleidofin started. Um, so, like you pointed out, I began my career with ICICI Bank, which was a large financial institution. And I was focusing at that point of time on the microfinance sector. I built that team in ICICI Bank. So that was really one of the starting points for what I did. Um, at some stage in life, um, the big gap that I started to feel was that savings was just not available, and we needed better entities to be able to serve customers. Microfinance wasn't at the size and scale at what you see today. And after having worked for 7 years at ICICI Bank, I did realize that we needed to create a better organization. And it was with that I decided to move on, and then decided to set up Northern Arc Capital in Dwara KGFS. We decided to see how could we harness the power of capital markets to be able to make sure that uh, we could work towards financial inclusion. And that's what we did at Northern Arc Capital in Dwara KGFS for a very long time. And for 10 years, I think we built a very, very, very strong business. We built a very strong brand for ourselves. And then we realized that uh, the world wasn't really evolving to be able to serve the needs of the customer. So when I started Northern Arc and Dwara KGFS, most of the financial services were being delivered through microfinancial institutions, which basically offered very small value of loans. And then with every cycle of payment, your loans would increase slightly. Uh, Now, in 10 years, a lot of customers had been with microfinance programs for well over 5 to 7 years. Um, Unfortunately, the products didn't develop at all, the products didn't evolve. So, if a customer was doing well, and if the customer wanted to now make a larger investment in their enterprise, they would still get the same 35 to 50,000 rupees. Um, in 2001, microfinance typically would offer to customers 15,000 rupees as a starter loan. And in those days, gold used to be around 3.5 to 4,000 rupees for 10 grams. So in 15,000 rupees, you could buy 40 grams of gold. And an average cost of a cow used to be around 8,000 rupees. So you could almost buy two cows. In 2026, gold has gone to 170. Loan sizes have not gone beyond 40, 50,000 rupees, which means that you can buy 3 grams of gold. Also, the cattle that people end up purchasing now roughly cost between 50 to 70,000, which also means that you are barely able to afford one cattle head. So, in real value terms, microfinance was just not growing at all. Um, the second challenge that we realized was that when it came to SME finance, there again, very little was happening. Most of SME finance was largely speaking some form of collateralized loan. So either people wanted to give loan against gold or loan against property. And once again, the challenge really is that if you look at some of the best and the largest names in this space, the sum total of some of these entities is smaller than one Credit Access Grameen, which is perhaps the largest microfinance company today. So we started to feel that most of the work is happening on account of basically process-based finance as opposed to underwriting-based finance. And that's basically what got us thinking about Kaleidofin to say that we can start to harness the power of technology and data and build credit models which is built on past customer data and a lot of alternate data which is going to get generated. And the idea was so powerful in our minds that we decided to move on from Northern Arc Capital. Northern Arc Capital was doing really well, and we were the founders. So it took us really almost like 7 wild horses to drive us out. But the idea of working towards um, now solving a very big problem of underwriting new loans for low income households who didn't have a very strong amount of data was just powerful enough to extract us out. So that basically was the gap. Uh, and then the second part of the question that you asked me about was that how are we using and leveraging AI to be able to do this? Um, that's actually a whole new interesting journey that we started to get into. And I would say this was something which was also very exciting for me. Um, so when you look at data today, data is has been expanding overall. Unfortunately, though, the kind of data that you want, that kind of data is limited. Um, so what we started to do first was we started to get data sets together, and we didn't start with an AI based methodology. We basically created a machine learning algorithm where we first started to look at transactions and started to see if transactions could be a good predictor of human behavior. Because at the end of the day, if you're trying to give credit to people, you're trying to solve for two things. One, does the person have ability to pay? And the second was, do the customer have a willingness to pay? And this behavioral aspect is the hard one. Uh, Credit bureaus are supposed to give you a credit score. Um, Unfortunately, again, the challenges of formal financial sector and informal customers is very, very different. So credit bureaus were not really predictive of risk when it comes to informal sector at all. So let me give you an instance of how we started to use transactions to be able to identify behavior. Um, so take into account, let's say, demonetization. One particular day in November 2016, um, the entire currency of this country disappeared. And given that entire situation, a lot of the customers in the informal sector situation started to face tons and tons of challenges. There was no cash, basically. So some customers defaulted immediately. Some customers didn't default at all. Some customers defaulted but were able to make alternate arrangements within a month. This was a time when Paytm and others started to come into play, and they were able to find an alternate way to get cash. There were some customers who paid loans after 100 days when the cash became fine, and some others paid back, let's say, in another 100 days, but after they took a new loan. Okay. Now, without me even kind of saying or kind of giving you an answer, I think all of us can draw out a hierarchy of who's the best customer and who's the customer who's the weakest in this situation. So we took data like this. Then we tried to look at other events, for example, floods in a particular place, droughts. We started to look at politicians having made an announcement to say that they will get a waiver. And with the multiple of these events, we started to look at customers to find out who defaulted, who did not default. And a lot of these put together started to give us our bare bones of the first model. Um, Over a period of time, we realized a lot of customers were new to credit. Um, they still hadn't borrowed formally, which means that they had no credit history whatsoever. And that's basically where the first time we started to use AI in a big way. So we created lookalike models to say, I may not know who you are, but I have somebody in my databases who looks like you or who used to look like you several years ago. And that became our next big thing when we started to build out our credit models. And then once we got onto this AI journey, we found multiple use cases. And some of the biggest use cases that we found were in early warning systems that could be used by banks, microfinance companies, any other lender to be able to predict what is going to happen to customers or risk. So I'm going to stop here, but happy to kind of go on and on. This is one of those topics which is just super exciting.
Yeah, I think what you've really touched upon is the idea of invisible customers who do not have much of a formal database that can be accessed for credit scoring, and then, sort of bringing them into the financial system into without really increasing the risk of their fallout, or without increasing the risk of the financial system that we're really talking about. And I think this is what Kaleidofin has been really working on. So, is there anything else that you would want to add to this invisible formal, customer database that you've been trying to address?
Yes, yes. So the moment you start to get to the invisible informal customer, where the data was limited, one thing that I talked about was we started to work with new to credit customers, and that itself was a very 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 large journey in its own right. But there is more to it. There are specific segments where we realized that we could start to work a lot in AI. So think about, let's say, the agricultural customer. Um, And while we don't really realize it as much, but the agricultural customers, the farmers, have been subsidizing the richer population for a very, very long time. If you look at just the agri risk and the natural disasters have been increasing over time. So the moment you start to look at some of these agri risks which exist, um, the farmers end up taking up a very significant part of the overall risk of yield loss and therefore income loss. Uh, Now, we started to think about, is there a way in which we can start to underwrite, let's say, farmers as a segment? And there we started to look at weather data, patterns of weather data, um, and then started to put it together along with price realizations. Sometimes when the production falls a little bit, you actually don't lose money because the price goes up. But that's not necessarily going to happen always. So the farmer risk is a combination of weather risk plus price risk plus yield risk. And through the power of AI, by using satellite imagery, we were actually able to create very, very strong models for farmers. These models today can be used not only for credit, but also to be able to underwrite insurance. As we started to look at some of this, we then realized that using AI-based models, we were able to get into many, many segments of customers which otherwise looked practically impossible for us to look at. One such segment, which is something which is very close to my heart, has been the agricultural workers. So when you have a failure of a crop, you have a situation where you can still assess the risk on farmers. But when there is a crop failure, the farmers also don't employ landless laborers. And what happens to their incomes is the next level of complexity together. And again, using AI-based models and by using satellite and weather patterns, we were able to create very strong models which allowed us to work with customers who were extremely low income. And some of this, in the absence of the power of technology, would have been impossible for us to start to work on. But the ability to be able to fill in the blanks, to be able to kind of say that I know two data points, but there is something in the middle, and that is something which AI has been huge for us to start to build towards.
I mean, this completely sounds interesting, and I'm sure that there'll be so many guys who are getting touched, which are getting touched with this model. Not just in India, but I understand that Kaleidofin is expanding this touch to Africa also now, which clearly explains the portability of these models. It'd be great if you talk about the influence there, and also how are these models being used for financial inclusion globally.
Right. So the challenges of the informal sector remains roughly the same. We worked in India. We took our models to Bangladesh. We're right now trying to take our models to Sri Lanka, and we've worked a lot in Kenya now. The challenges of the informal sector is the same. Data is not available. Banks don't want to lend to some of these customers. Um, and frankly, when you look at customers, there isn't a single model that can reach financial products to everyone. Take into instance, India is almost like a continent. If you were to look at a customer in Tamil Nadu and compare an average customer in Tamil Nadu with a customer who's coming from a remote part in Bihar, the income levels are very different, the risks are very different, the caste structures are very different, access to common property resources is very, very different. So when you look at these customers, and if you were to create a singular model, what you'll end up doing is just because the incomes in Tamil Nadu are very high, you will end up excluding a lot of customers from Bihar automatically because they've been put on the same scale. Um, what we have tried to do, therefore, is not to create a single model, but to create multiple models which work for very, very small clusters of population. So when I go to Bihar, let's say if I'm working with farmers, I don't have one model for farmers. Um, think of a farmer who's working only on rain-fed agriculture. Uh, but now compare this farmer to somebody else who has irrigation, and now compare this same farmer to somebody else who's not growing cereals but is growing fruits and vegetables, and compare the same farmer to somebody who's located on the outskirts of a Patna or Gaya, and if you were to compare this same farmer to another one in Patna, who also has, let's say, a dairy animal with daily cash flows, the farmers who are closer to Patna are growing vegetables, have a dairy animal, will look so much less riskier than the farmer who's growing cereals in a rain-fed situation, that that farmer will never get money as compared to this farmer. So what we had to really do was to think about people in the form of a small cluster and build models that reached out to that cluster. Um, by customizing it to that level, the moment we started to go out of India, for us it was almost like we are including a new state now. Because anyway, we were going to understand customer characteristics, we were going to create new models and algorithms for the customers. And that just worked seamlessly for us as we went out of India. So we can't use the same models. We, of course, need to add a lot more data when we go to other places. But the customer challenges remain the same. And our methodology of building the models has been scalable for us to be able to work in many of these locations. So that's really been the power that we have been trying to harness as we do this. And we've been positively surprised ourselves with how much the problems look similar, even though the context could be extremely different. So put together now between various countries, our models have been used to underwrite loans for over 11 million customers. We've used our models to underwrite over 89,000 crores in total loans, and our risk across underwriting these loans has never crossed 3%. As we speak now, Indian unsecured markets are going through some very significant risk. Most entities are showing PAR 90 numbers in the range of 12 to 18%. Kaleidofin's numbers have continued to remain sub 3% during this time. So that's basically where we've started to get some validation now that on a very large base, we are still not seeing our models falter. Um, and the one thing that I'm particularly excited about is that you can always make a model which has low risk by rejecting a lot of customers. You can make the model much more penal, but given the fact that our agenda was financial inclusion, um, we made a huge impact in that space as well. So, on an average, if you look at the markets today in a high risk environment, most people are sanctioning loans to between 10 to 25%, and rest all of the customers are getting rejected today. Kaleidofin today is accepting between 60 to 70% customers. Um, and when the risk was lower, the market was accepting sub 25 or sub 30% customers in places like Tamil Nadu. Places like Bihar were still showing something around 40 to 45% acceptance rates. Our acceptance rates used to be upwards of 80%. So not only have we been able to keep the risks low, we've also been able to make sure that we are rejecting far fewer customers in maintaining that. And that from an inclusion point of view becomes huge. And that's what also has worked for us in places like Kenya, where market delinquencies are significantly higher than delinquencies in India. On an average, Kenya shows 15% delinquency, while India shows something around 5.5% delinquency. And that's where our model started to just immediately find fail.
So I think when we talk about AI, touching so many stakeholders, I'm sure that the interface that it has with various stakeholders is very different, right? And you also mentioned about the chi-score. I'm sorry if the pronunciation of it is
No, it's
chi-score.
absolutely right. It's chi-score.
All
Yes.
right. So I would really appreciate if you would introduce us to how does that really work and how does this interface look for different stakeholders, say the financial inclusion entity and the people who are actually accessing it, and say uh, if there's a regulatory body across it. So the entire value chain around this.
Yes. So let me start with a regulatory question first, which is not my favorite topic and perhaps the least interesting for everybody as well. So I think the regulation changes very dramatically from country to country, and I think we're trying to always find our place in the sun to be able to do this. Having said that, given the fact that we are dealing with data, we ourselves as Kaleidofin believe that two, three things are really critical here. One part is that customer data protection is absolutely critical. The kind of data that we have access to today is huge. In the wrong hands, this data is going to create several challenges. So customer protection is one of the most important things. What we have done is that we've made sure that we don't collect any PII, which means that we can't identify individuals. So now anybody gets access to this data set doesn't kind of create any harm. But a lot of this data can be collected by with PII as well. So one part is just customer data protection. The second aspect is bias. And this is one of the big challenges when you start to look at AI, is that AI can also increase bias as opposed to reducing it. So if in the past loans were being denied to low income households, and if you're training your data set on the basis of data set which was ignoring all low income households or ignoring all farmers, or was giving very small quantums of loan to this customer base, what typically ends up happening is that the model also learns that maybe there's something wrong, I should not be working with them at all. So the bias comes from the fact that the past data itself had a bias of who was able to access credit. And that's basically the second big challenge of how do you make sure that bias does not exist, and how do you make sure that bias doesn't creep in even without you kind of wanting to be biased. Bias is easy to creep it into these points. So I would say those would be my two big regulatory issues that need to be sorted. The third one is not a regulatory issue, but with customer data protection, one challenge that is happening is that most places are making it harder for entities like us to access data. But the power of AI comes in only when you have whole data sets that you can train your models. So today, under the new privacy norms, it's becoming harder and harder to be able to access data. And that actually works against the interest of customers. What needs to be done is do a little bit more work on making sure that anonymized data sets can be accessed. But today, there is no thought about how do you create access to anonymized data sets for training or AI. And in the absence of that, training becomes very hard. We were very fortunate that we ended up starting with a lot of data coming through us through partners who engaged us as a service provider initially. So we're able to work on those data sets, but I would say it becomes harder and harder to access. So that I would say is one of the principal challenges on the regulatory side that I start to see. On an overall use of AI, I would say that um, the way we look at risk right now is that most entities who are engaged in financial services acquire risks at two different points of time. One is you acquire risk at the time of giving the loan, but then you can also acquire risk without you doing anything at all during the currency of the loan. So think of a loan as a 24. And during these 24 months, you could acquire new risk. So when you brought in the customer was great, but over the next 24 months, a lot can change. For instance, you brought in a customer thinking that the customer currently is borrowing only 50,000 rupees, and you can add another 50,000, and that's completely fine. But imagine a situation where you gave the customer a loan, and after you gave the loan, the customer also went and borrowed another 150,000 from other sources. Now, at the time of onboarding this customer, the risk was great, but subsequently the risk changed. Similarly, think of the current context. There is a war that happened, and suddenly anybody who needed LPG and was a small eatery is under tremendous stress. Either they are shutting down, or they're curtailing hours of operation, or they're buying LPG at a substantially higher price, which is all eating into their budgets. And suddenly, this small eatery could now be at the verge of defaulting, or could be at at a risk of defaulting, even if they are not. Right now, nobody can plan for something of this sort, but these things will end up happening. So what Kaleidofin has done is we've created two products for ourselves. One is Kai Score, which is a scoring model. The second product that we've created is something called Kai View, and we sell it in two forms: Kai View, which is a larger product, and Kai Monitor, which is a monitoring product. Um, and the Kai Monitor really tries to look at some of these early warning symptoms and then reaches out to institutions for them to be able to manage their risk and act in a manner which is much more proactive than reactive. Um, and a lot of this risk management is triggered by AI based alerts to say that rather than giving you 200 things that can go wrong in your operations or 200 different items, which are not necessarily helpful from a human mind's point of view. But what we do is we use AI to find out five or six critical things that if you were to address, you will end up addressing 60, 70, 80% of the risk that you're going to accrue. And this is where the power of AI and risk management starts to shine in a very significant fashion. And this is one thing that I would say has also been a big sale from our side over the last 1.5 years when the risk has been spiking. But this is a place where we've used AI much more significantly than anything else right now in just triggering risks, looking at risks, and creating early warning systems.
I think this has been quite a journey for you, starting from microfinance at ICICI to Dwara, and you've seen financial inclusion really chart its path the way it has. So, what exactly would be your takeaways of how of the evolution of financial inclusion, if I may, and what does the future of AI-led financial inclusion really look like?
So, the challenge really is that financial inclusion, I think, over a period of time, is not attracting the kind of attention that it should be attracting overall. Um, in a variety of ways, I think we are all starting to think that financial inclusion is now something which is not super critical when it comes to India. And I hear this a lot. I hear this from policymakers. I hear this from equity investors. I hear this from donor organizations. And I think it's only partly true. What has happened over a period of time in India is that we have a lot of entities trying to offer credit to customers. And these are all cookie cutter models that have been using some known variables to be able to offer loans to customers. And to my mind, a lot of entrepreneurs today think that this is an attractive investment avenue. It gives significantly better returns than what traditional NBFCs would end up giving to you. But I think in the process, what has gotten missed out has been product design, product innovation, making products that are conducive for our customers. And I think, barring credit in financial inclusion, everything else has gotten left behind as well. We do very little in terms of investment products, or pension products, or risk products like insurance. Um, and to my mind, AI today offers an opportunity to be able to do all of this. Risk management is becoming easier and easier. New product design is becoming easier and easier. Customer service today can be used and given via AI bots, and it's becoming harder and harder to distinguish between when are you interacting with a human being and when are you interacting with a bot. Although I would still say that for the foreseeable future, those bots are way too expensive. For the time being, we are stuck with bots that nobody wants to interact with. But I think that is changing very rapidly. And I almost think that the new wave of financial inclusion requires a new set of entrepreneurs who are thinking about this aspect from a developmental point of view, in addition to it being thought about from a business point of view. That's one. And I think we need this new brand of entrepreneurs who are once again coming and thinking about how can I work and use AI towards the betterment of the society and in the process generate very significant returns. This is a very large market that we're talking about, and we have very little competition. Um, so, yeah, that's how I see what the future of financial inclusion could be. I see very, very few entrepreneurs doing this. So I hope more would jump in.
I think very well said. I think it's not just about access, but about financial well-being and well-being in general for all the customers that we're sort of looking at. I think I will now throw the floor open for any questions that the audience might have for you. Uh, so yeah, I think there was one question in the chat box. I'll just read it out for you.
Yeah, I can respond to that question. So the question that I have here is that have app-based payments, payment providers such as Paytm, have they been able to make customers more bankable or credit-worthy or loan takers? Um, so the starting answer is yes. The more complicated answer I will give as I'm responding to this. So more information is always helpful. And if there are customers who were not using digital payments in the past, and now they have started using, let's say, digital payment systems to be able to get payments in, it creates a new wave of data. And that data is extremely helpful to be able to give out credit to them. I can clearly tell you that from my experience, the number of credit takers have increased. The formal credit flow to these customers has also increased substantially. So if I were to give you three examples, one of Paytm, second of PhonePe, third of MobiKwik, I would say that each one of these three entities has turned profitable largely on account of the fact that they were lending, and most of their lending was based on the basis of QR code payments that they were receiving. Uh, so given that that has happened, um, can more happen? Yes, absolutely. I think what has happened is that through a lot of the work on these payment app-based entities, we are starting to see new credit flowing into the customers' businesses connected totally to QR code-based payments, but it's limited to that. If the customer has a much larger business and only 20% is coming, or 30% or 40% is coming via QR codes, that part of the business is getting financed. The remaining 60% or 70% of the business, which is still cash based, there is nobody who's kind of looking at it. So in effect, some things have improved, but it's not completely gotten to a place where it can get to.
Any further questions? We could have people turn on their videos and ask questions. I think none as of now, but I would definitely have a question on this. Um, when you collaborating with all kinds of financial institutions. So are we also looking at insurance products, or something beyond lending? And what is the manner in which what are the different solutions that people are sort of coming up with? Because I remember working with things like securitization of such, things, and
Yeah, yeah.
but only going to a limited extent. So it'd be great. And how has it really progressed across these years? The ticket sizes, the deployment of these funds.
Yeah, yeah. So we're working with a gamut of organizations. We work with banks, we work with NBFCs, any other small lender. Some of these are now digital lenders who don't have a balance sheet of their own, but they're basically running platforms to be able to lend. So we are working across all of these organizations, but largely in the lending space. The work that we are doing in Kenya has dovetailed nicely into what you said. We are working a lot in securitizations in Kenya. Kenya has not been a place where securitization was happening in the past. There are lots and lots of regulatory reasons because of which it becomes very hard. We've seen two transactions there. Both were like $100 million transactions. The cost of doing these transactions was almost $1.5 million. And that made it very difficult for any smaller organization to ever come forward and use debt capital market based delivery. And I think this is one thing that we've tried to sort out in Kenya. We've now created a full debt capital market space. And in doing that, we've been able to cut down the transaction sizes to almost $2 million a piece. We've done two such transactions. And I think over the next few months, we will start to do a lot more. So there we are catalyzing debt capital markets business as a part of our work. On the insurance side, I would say that I would love to do a lot more, but that is where we've got very limited traction. We're doing a lot more on insurance in Africa, where we are finding embedded insurance being very exciting. And the way we are appraising credit risk, we've been able to use satellite imagery data there to also think about insurance. Nothing has been delivered on the ground yet, but I think we'll soon have a product which is embedded into lending to agri farmers, and then start to see how that could work out. But I wish that we were able to do a lot more with entities that were on the insurance side.
Thank you. Any more questions from the audience?
Yes, I have one question. I am Vipin from PRM 41. Uh, Sir, hi. Actually, I am currently working for FIG segment, where I am responsible for MFI's lending. But uh, I'm not actually very much exposed to the kind of data models earlier, where I can look into the delinquencies, where the MFIs are reporting their numbers, and how genuine they are actually working on reducing those delinquencies by adopting such models. Today's session was like it is new to me, but definitely I have gained uh, very good insights into them. But my question is, when we are just going through financials and while we are interacting where normally we interact with the treasury teams mostly. So what should be my questions to them where I can learn that they are adopting such models and there is a genuine work from on their side where they are working to reduce the delinquency or at least in the uh, when they are giving their numbers for 3 4 years plan that they are growing and still they will be able to generate a good quality of assets. So just want
Yeah,
to, yes,
yeah.
I might not be able to summarize in a better
Hmm.
words, but I
No,
think
no, no,
you
no
got it.
worries. I think I've understood your question.
Yes.
So I would say that the use of data and database underwriting is still picking up. Most people believe a lot in group-based lending, and therefore they're still not using credit scoring models to be able to underwrite customers. They are largely building their models without it. And I can tell you that, like I said, our models have been used to underwrite over 80,000 crores, out of which 88,000 crores, out of which I would say at least 60,000 crores would have been in microfinance. But microfinance portfolio is almost 3 lakh crores. So it's still a significantly small part of the total business that microfinance does. Most people, my straight answer to you is, are not using these models. What we've done though is we work with banks directly. So we work with SIDBI, for example. Every single loan that SIDBI gives today under its Prayas model, by when the loan is given by them, they use our models. Similarly, when we work with Federal Bank, when they are giving loans to microfinance companies as well, they are using our models to be able to understand what is the quality of loans that have been originated. So rather than just relying on PAR information shared by the microfinance companies, we actually do a full scrub of their book and we give them a detailed insight into what proportion are good customers, what proportion are not so great customers, and how is the risk panning out for this entity. So we are actually supporting Federal Bank today in a big way as we start to think about underwriting these customers. So there are a lot of ways to associate overall on this, but I would largely say most MFIs are not doing this. Your question straight to them will be that, are you using any credit models? And when they say, if their answer is yes, your next set of questions to them should be that, is this a business rules engine or a business scorecard? Or do you have a model which is based on statistical understanding? And if the answer is that it is a business rules engine, then you try to understand what those rules are. Typically, these are basic rules. If they give you a sense of the fact that it's a statistical model, then you should ask them to be able to show you a back testing of the model to understand the efficacy. They should be able to give you a test use case for you to understand whether it's good or not. But I would doubt that there are too many people who are using these models to be for them to demonstrate it.
Got it, sir. And luckily, actually, I'm working with Federal Bank only towards the NBFC lending side. But we have
Oh,
some,
wonderful.
we have team which are directly into microfinance segment, which are
Hmm.
generating their own book through DA and other securitization. But
So we should, why don't you connect to me separately?
yes, sir,
We are
definitely, I will
working,
love
we
to.
have a solution for Federal Bank already live for us to be able to help you choose the DA books and others. So we can separately catch up. And
Yes,
I'm
sir.
sure that it's just been introduced like 3 months ago. So I'm presuming that it's still going through product by product validations. Very
Okay,
happy to
sir.
walk you through. We have a solution for Federal, which is, and Federal is already signed up. So you have to pay nothing. It's already there.
Yes, sir,
Everything is,
definitely. I will catch up with you separately and would love
let's
to
do that.
learn more about this. Okay, sir. Thank
Absolutely.
you.
So I have a question here on the chat, which is what are the reasons for failure of your customers? So I would say that there will always be some losses in portfolios, come what may. And I think when we look at the informal sector customer base, we believe that business risk of between 3 to 5% is absolutely normal in these markets. And the reason why we say this is that a lot of our customers take disproportionate risks. So right from a shop which may have a not so great roof to a place which is not kind of sealed from the elements, so water can come in, flood waters can come in. Typically, low-income households are located in places which are much more prone to floods, for instance. So there are many, many reasons for which there will always be some kind of risks there. What we are actually much more concerned about typically is the customer having the willingness to pay and can we identify those customers? And if we can use insurance to be able to minimize at least insurable risks from customer failures, is what I would say are the important ones. From our point of view right now at the model level, we have not found a very significant weakness which tells us that this is a reason for failure that we need to cover. However, we continue to work towards one important piece, which is income estimation. Income estimation, given a lot of the businesses are in cash, people are always trying to underreport on taxes. It always becomes very, very hard to be able to understand the true incomes of customers. And if there is one reason or one thing that we want to continue to strengthen, is going to be income estimation in the work that we do, which plays to the second part of assessment that I was talking about. That one part is ability to pay, and the second is willingness to pay. Ability to pay is which you what you clearly get towards as you are able to do income estimations.
Thank you. I think Puneet, this has been a wonderful conversation and really something, which has walked us through the entire pioneering work that you've been doing. I would thank you for being a part of this talk and, hand-holding us through the financial inclusion space that you are working in, especially with AI and data and how is it molding this space essentially. So yeah, I think we're towards the end of the talk. So any last words from you, and then we can sort of sign off.
No, thank you so much, Imani, for having me here. It's always a pleasure to be amongst alumni and have a conversation. Thank you again.
Sorry, one more question. Can I have one more question?
Yes,
Sorry.
yes, absolutely, sir. How are you?
Sorry. Sorry. Hi, how are you? Uh, okay, so here in Tamil Nadu, there are so many self-help groups. Women self-help groups are they are forming the enterprises.
Hmm.
So have you tried to work with these women, especially rural women who are formed this self-help groups in thousands of groups are presently there. So, how effective are these groups? Are there any, successful models that you have found?
Yes. So SHG groups in India have been kind of super successful in the past. And I can tell you that Tamil Nadu has this old, long history of having some fantastic self-help groups. The work that Dhan Foundation was doing in the past was absolutely amazing, and I think they were amongst the pioneers of microfinance. So there is a lot of work that came out of that. Over a period of time, what I would say is that the group-based models started to evolve into two forms, SHG and JLG-based models. And given the fact that SHG-based models were getting formed by a lot of government setups, what started to also happen was that some of these SHGs were also used for lots of government programs. And now the purpose of the groups started to change. I think one of the key learnings for finance has been that if you want a successful group from a finance point of view, the core purpose for which people associate should be that they want to make their lives better. It has to be a self-help group which allows them to be able to get access to credit, as opposed to a group getting made where people came together to get certain benefits from the government. So I think the quality suffers a lot if the group is not purposive. But having said that, I would still say that there are some excellent examples of group-based lending through SHGs, which continues to work. We are right now trying to collaborate with the National Rural Lives Livelihood Mission. And through them, we are trying to access multiple groups in multiple states. That conversation is going really well. But I would still say that we have to crack and get into this particular space. Working with the government is never easy. And it just takes its own time. But I think very soon we'll be there.
Thank you. Thank you. Thank you.
Thank you. I would just want to add two bits to this because I worked closely with one of the organizations that was lending to SHGs, and it was a new model wherein they were trying to actually screen pass through SHGs to find out women entrepreneurs who could be then given MSME loans, and I think they're doing pretty well. I would just type out their name here if any of you would want to be in touch with them. This was basically funded by IndusInd Bank, and I remember that we actually went through the entire process of them starting. So this was one of the first startups that was actually funded by the inclusive banking group at IndusInd. So I think pretty interesting that you brought that up.
No, thank you for sharing. I will definitely reach out to this group and see if there's something that is possible.
Yes. Thank you so much, Puneet. Thank you so much, everybody. This has been a wonderful conversation. A lot to take back home, Puneet. Thank you.
All right. Thank you once again for having me. Have a good evening, everybody.
Thank you.
Yes, thank you.